Good morning. I hope you can hear me. Welcome to this webinar on IoT and artificial intelligence in finance. We are going to wait a few more minutes before we start. So please be patient, and then we will start the webinar. Actually, let me share my slide. Great. Okay. Nope. Okay, maybe we can start. Welcome everybody once more to this webinar on AI and big data in fintech. My name is Fabrizio Lillo. I'm professor of mathematical finance at Scuola Normale Superiore and of mathematical methods from economic and finance at the University of Bologna. And I will be, let's say, the moderator and of this webinar. Just a few general technical aspects. So the first one is that, as you will see, the webinar is organized in few talks, short talks, followed by the Q&A session. So I invite, of course, all the presenters to make questions during the Q&A, but also people from the audience can ask their question in the question box of GoToMeeting, and I will try, if possible, to select some of them and to ask the question. As you know, this webinar has been recorded, and the video will be available on the TechShare platform in the next days. They will be advertised with social media, and so you'll have access to the material later at the end, let's say at the end of the whole TechShare Day 2021. I have also to mention that this initiative is is carried out in collaboration with the European Institute of Innovation and Technology through the ELISA consortium, which of which both Scuola Normale and Scuola Sant'Anna are part of. So what we're going to see today, essentially, let me go through if I'm able to change the page. Let me first of all show you what was the planned agenda, because there is some small change. So this was the agenda that you have found in the say in the presentation of the webinar. Unfortunately, one of the speakers couldn't attend. In particular, Riccardo Prodan from Unicredit had some, let's say, issue in participating to this webinar. So I'm slightly changed the agenda of today's in the following way. So essentially, we will have the same presenter as before. We will have Michele Treccani from Algorand Foundation, so a fintech company. We will have Francesca Medda from Consob, a regulator, Fosca Giannotti, which is also professor at Scuola Normale Superiore on artificial intelligence, and Daniele Regoli from the banking industry, let's say from Intesa San Paolo. At the end, let's say I will keep again the stage, we'll take the stage, and I will make a short presentation about the research activity of the quantitative finance group at Scuola Normale Superiore, especially the one which is more related to the topics of this webinar. Okay, now we will want to go deeper into the topic of today. So what I'm going to do now is a sort of overview and mostly posing questions that probably will be discussed during this webinar and by the panelists. Okay, so first of all, why we are here, what we are discussing now, we're discussing about two main aspects, two main change that has occurred in the recent year. So the first one is the occurrence of what is called financial data science, which is a new discipline, if you want, which emerged thanks to the availability of large data set. This is more general data revolution, which completely changed our understanding of the world, the way in which we model the world, we make prediction, and we create new business opportunity. As typically is happening all the time in this type of aspect, in this type of situation, well, this creates a lot of new technological, conceptual, and methodological challenges. Here I made a list. It's very difficult to make a list here because there are so many topics that it is difficult to follow. Of course, one of the main points is the huge speed of data production, and so you have to have methods and technology to handle them. You have to have, of course, the problem of extracting information from complex sources, so for example, tweets, text, images, and so on and so forth, combining data set of different origin, and so on and so forth. This, of course, has created also a new industry, which we can call Fintech, from financial and technology, which is trying to exploit this big opportunity of new data for finance in order to create business. Together with the availability of, if you want, of the raw materials, which are the data, this has been accompanied by an impressive evolution from a methodological side. And this has created what we can call financial artificial intelligence or financial machine learning. I'm going to use the two terms more or less interchangeably. And essentially, we have, in the last 20 years, we have experienced a huge increase in the complexity of and the sophistication, let's say, of new methods for data analysis of this large data set, for tasks like prediction, classification, regression, analysis of text, and so on and so forth. This, of course, has been possible exactly because there was this availability of data. So if you want a sort of co-evolution, let's say, of data and methods that go hand by hand all the time. This change, of course, also this change has created new, again, technological, conceptual, methodological challenges. Some of them will be certainly discussed in this webinar by our panelists. Well, of course, we have a huge variety of methods that can be used in different settings, but there are also very interesting challenges, which are, for example, why these methods are working from a fundamental point of view. Sometimes you cannot really, let's say, prove theorem to show that why these methods are working, but also problem like problem of explainability that we will hear about later on, which means try to understand why, being able to explain why our machine gave a given answer. This, of course, is much more general than finance. So let's focus a little bit more on finance. So in preparing this brief introduction, I made use of a recent report by OECD about artificial intelligence, machine learning, and big data and finance, which identified essentially four major trends, four major areas of application of artificial intelligence and machine learning in big data in finance that you see here in this plot. Essentially, one is about asset management, the other one is about credit intermediation, algo trading, and of course everything which is related with blockchain. And we are going to hear something about all this in this webinar. Of course, I feel this a little bit limited in scope, in the sense that there are many more, in my opinion, there are many more application of artificial intelligence and big data in finance. You can think about insurance, payment system, customer experience in the banking industry, the market structure, which is sometimes related to blockchain, but not only. So really, what we're experiencing that many fields of finance are being deeply transformed by the advent of artificial intelligence and big data. In particular, I want to go a little bit more in depth in these four topics. I will start with algo trading also because this is one of the topics we are, as you will see in my last talk, is one of the topics we are investigating more in the Scuola Normale, high frequency finance and algo trading. I mean, it's very difficult to get numbers, but you know, if you browse a little bit, you will find numbers like 70% of the overall US equity trades in 2020 were handled by some kind of AI supported system. I mean, I don't know exactly what does it mean. AI can enter in many different aspects, but definitely the process of trading itself is being completely transformed by the advent of artificial intelligence. And this, of course, created a whole new industry of algorithmic trading, which sometimes make use of very fast algorithms. This is called high frequency trading, which of course require the use of very sophisticated prediction tools for predicting the movement of price on very short time scale. There are of course issues that can be highlighted by this advent of algo trading. One is the arrival of earning behavior. The problem that many algos are in fact similar one with each other, are not so they're apparently different, but they produce the same output, and this can create some sort of earning behavior which can essentially destabilize the market and create big swing in the price, as we are observing all the time in the recent period. There are also, of course, the possibilities. This might be relevant, for example, for Consob to use some of this AI method to devise illegal algorithmic procedure like market manipulation and market abuse, and this is something also which is experienced quite frequently in the industry. In terms of asset management, so we're going now on a different time scale, on a longer time scale. I mean, the main source is the possibility of using new unconventional source of data to create signal for your trading investment. I mean, I like very often to quote these two examples. One example of company which is, you know, there are many companies that are providing satellite images on demand, let's say. And for example, there are funds that are using these images to get information about the real economic activity of companies. For example, the number of cars in the Disney World parking lot can give you an idea about the number of customers that the Disney amusement park have, and therefore try to find faster some signal to predict the market movement. There is another very nice project, for example, this billion price project from the MIT, which is essentially browsing the internet, looking for prices of goods in different vending platforms in order to have a real-time forecasting, sometimes called nowcasting, let's say, of macroeconomic variable, like for example inflation, right? So you can track in real time the change in price, and you can track how inflation is changing without having to wait, you know, for official statistics figures. And you know that inflation is becoming one of the main will become one of the main issues in the coming year. I mean, again, here if you look at this is again the bottom left figure is taken again from this OECD report, which is suggesting that essentially funds that are using AI or they declare themselves that they use heavily AI typically tend to outperform significantly other hedge funds which are not declaring what is happening. So there is of course a big pressure in investing in AI hedge fund because they seem to provide higher higher return. Credit intermediation is the other field which has been strongly affected, again, because banking system is a lot about lending money, and lending money requires to have information about the borrower, but how do you get this information about the borrower? Well, you can now use not only data that you can ask directly to the borrower, but data that you can get from social media, that you can get from payment data, and so on and so forth. And so you can provide more precise assessment of the creditworthiness of individuals, but also of companies. And this has been done. There's a whole industry out there which is trying to use unconventional data, so to say, so not balance sheet data, but say other data, even from the web, in order to improve the assessment of the creditworthiness. Again, here we will there is a problem. I think that Fosca Giannotti is going to maybe also Daniele Regoli is going to talk about this. I mean, there is a problem of when using, let's say, machine learning and artificial intelligence method to get a credit scoring credit score to a borrower, then of course you have to be sure that you are able to explain essentially why you are denying a mortgage to someone who is asking a house, and that you are not discriminating, and that you are fair in some sense in your decision. And last but not least, of course, the blockchain revolution is changing completely the way in which financial intermediation has been performed. Not only cryptocurrencies, of course, which is just a minor aspect, in some sense important, but minor aspect of the use of blockchain, but it's really about the development of smart contract and in general decentralization and disintermediation. So now there are a lot of companies that are being able to do complex tasks like bond emission or securitization completely on blockchain. This is also changing the way in which market works. I mean, there is probably Michele Treccani, the next speaker, is going to talk about this. There is the field of decentralized finance, which is trying to disintermediate completely even markets in some sense. And so markets are not anymore, probably in the near future, market will not be financial market as the market we observe today, because blockchain will allow to have a more direct interaction between buyer and seller without the intermediation of intermediaries and of markets. Of course, here there is a very important role of regulators, and likely Francesca Medda is going to tell us something about this. So as you see, just to conclude, there are a lot of issues, and these are again from this OECD report. I mean, are some of the risk and the issues that are stemming from the deployment of artificial intelligence in finance. Again, some of them we will see today. I mean, big opportunities, of course, but also risk and issues that are emerging. On top of this, I've listed in my very last slide some of them that I would like, if we have time, to discuss in the Q&A session of the panelists. I mean, one, of course, is the lack of explainability of some of these methods, which is fundamentally incompatible with existing laws and regulation. Okay, this is one of the main issues that clearly we have today. There is a problem of feedback effect, which probably we are not going to discuss, but I mentioned it before. I mean, again, according to OECD, the use of artificial intelligence amplify risk that could affect the financial institution safety and soundness, and in particular, they can create positive feedback and they can enhance, let's say, the risk of systemic event in the market, like big market collapse, like the one that we have experienced, for example, recently. There is the problem of data. The data quality, of course, is a big problem, especially when data are, collected collected from, for example, from the web or from other sources that, of course, can allow for biases and discriminative result. There is, of course, a all important issue about data privacy and confidentiality. This is, of course, much more general than the problem of finance. On the methodological side, one of the aspects which I find particularly interesting is the problem of regime switching. Models are typically require a lot of data to be trained. They are trained and essentially they believe that the system will remain the same. But we know the change is, market is changing all the time. Look, for example, the COVID situation, how the financial market changed with the arrival of COVID and the first lockdown is something which has never been observed before. And of course, the artificial intelligence methods are not always ready to adapt themselves quickly to a regime shift, to a change in regime. This is something that is a big problem, because this can create wrong answer, let's say, for example, of the investor to change in regime, because this is not identified immediately. And finally, well, last but not least, this is a problem, of course, which has been discussed by policymakers by and large, is the fact that in general, AI in financial industry may result in potential job losses across the industry, giving rise to unemployment challenges, right? So this is a general problem that we will have to tackle, and it is true for any technological revolution, but given the speed at which this technology is entering in the field, we can expect that the market, the job market can take some time to adapt to this major change. So that's it, what I want to say. But just to present, let's say, some of the main areas and the main issues, some of the areas, and some of the issues that are emerged that, as I said, will be discussed by our panelists. And so I would say, without any other, without wasting time, I will pass the word to our first speaker, which is our first panelist, which is Michele Treccani, which is responsible of analysis and market research at Algorand Foundation, a fintech company. So let me try to see if I'm able to do this. Let me make him presenter. Michele, are you ready?
Yes, go ahead.
Very good. Now you are the presenter.
Okay. Now I'm showing my screen. Please confirm me that you are viewing my presentation.
Yes.
Is it okay? Cool.
Yes.
Okay. So Fabrizio, first of all, thanks for inviting me. And today I will talk about decentralized finance. But word of caution, because by looking at your presentation, I have to admit that I will focus on a small subset of the decentralized finance that you mentioned, because it's a huge ecosystem of very heterogeneous parts. And in particular, I will concentrate on decentralized exchanges. In order to understand the peculiarities of decentralized exchange, I will start with the crypto-centralized exchanges. They can be seen as one of the possible on-ramp, off-ramp solution. There are systems that enables to connect the fiat world, the usual currency, USD, euro, with the crypto world. Because, as you may know, a blockchain is some kind of blind with respect to the external world. So, if you want to have some Bitcoin, some BTC, for example, you can set up a mining ring and do your part in the proof of work consensus mechanism, and you get BTC. Other, let's say, sorted by technical difficulties, ways to get into the crypto world could be exchange them physically with some services, or maybe the easiest way is to set up an account in a crypto centralized exchange, which is considered a so-called custodial solution, in the sense that you have not possession of the private keys of your related Bitcoins, but this is handled by the centralized exchange. Now, suppose that you want to swap, that you want to invest in, for example, Ethereum, another cryptocurrency. And if you had taken, I would say, the red pill of decentralization, you would install in your PC both the blockchains, both wallets, and perform what is called an atomic swap, that allows you to swap a fraction of your Bitcoin in response with some Ethereum in your private wallet that are completely under your possession. So, with the absence complete of a counterparty risk, you can perform this operation with a trustless counterparty that you don't know and you don't even trust. this is, I would say, the hard way. The easiest way, also in this case, would be to use the centralized exchange. That I would say that in this case they are cross-selling a service, because they started as an off-ramp on-ramp solution, and now they allow you to swap between BTC and Ethereum. The swap is almost instantaneous with a fee that you pay to the central exchange, but keep in mind that in central exchange, the swap is represented internally, only internally in the ledger of the exchange. So there's no an evidence on the two blockchains that you really possess this quantity. So paradoxically, you are relying on a centralized authority for investing into projects that have a core the decentralization. So it's quite strange. Let's see. Centralized exchange are more or less like traditional financial exchange, and so you can have you can play the part of the liquidity taker. You want to swap Ethereum for BTC, so you put your limit order of market order, and you are subject to the usual slippage. That is the degradation of the price that you have since the size of your order is relevant to the limit order book present currently in the market. On the other side, there are liquidity providers. There are actors, which are usually, in this case, sophisticated agents, because they need to continuously monitor the market movements and update their position. They're usually they put on the best, near the best bid and best ask, because they compete with other liquidity providers for the volume of transaction. It's interesting to note that both these actors pay transaction fees to the exchange, and liquidity providers essentially they gain from the spread of the best bid and ask, and their let's say goal is to have a zero inventory at the end of the day. So they do not want to have let's say a delta position on the market. Since I would say 3 or 4 years, there exists a third way, and here we can see the first what we'll see later on, that in blockchains there are, let's say, shades of decentralization. The third way is decentralized exchange, and the main building block are the wrapped tokens. That is, suppose that you want to trade on the Ethereum blockchain, you have to have internal representation on the Ethereum blockchain of the other token. For example, wrapped BTC, WBTC, is a representation on Ethereum of BTC. In order to have this internal representation, you have to, let's say, introduce what I would say a residual counterparty risk, because you have to interact with a custodian to which you transfer your Bitcoin. The custodian transfer to a smart contract the action of minting, and you receive the wrapped BTC on your, let's say, Ethereum account. The centralized exchange relies on this block and enables the swap between representation of different assets in the same blockchain, but without an intermediary. Here again, I focus on one particular, but it is I would say the most popular way of building the centralized exchange, and this is the automated market maker. It's essentially a smart contract that lives on the blockchain. Let's focus on Ethereum, for example, that except from the inception, doesn't need no human intervention during the working time. You can interact with the AMM as the financial market. It represents, in some sense, one financial market, completely algorithmic. You can be a liquidity provider. That is, you deposit a double quantity of token A or token B, and at inception, the ratio of these two quantities decides, in some sense, the price of that is currently set in the AMM. It's quite strange because there's no entity that decides the price. You decided, in some sense, arbitrarily at the beginning, and we will see that you should decide it, let's say, the most near to the other market pricing of the same entity, of the same token, and the liquidity provider receives the shares of the pool. Then other actors, that are liquidity takers that want to trade against the AMM, if they think, for example, let's suppose that here the ratio is 10:1. Suppose that outside there is a real market with in which they exchange 5:1. Okay, so there is possibility of arbitrage, and the liquidity taker insert 1 token B and receive 10 token A in this case. Okay, so and he can make this arbitrage, but the healthy part of this exploitation of arbitrage make the ratio of the Uniswap of the pool to be adjusted according to external price. So in this case, arbitrageurs play a fundamental role in making the AMM what is called a price oracle. There is a reliable and robust price estimation of the token. To go more in detail, there are different implementation of the AMM. Let's stick to the most basic that I think that is most interesting. That is the cost and product automated market maker, which implements the following equation for calculating the quantity that would be transferred for the liquidity taker. We realize that in this case the slippage is algorithmic, in the sense that you can make the whole calculation and realize that the slippage is essentially proportional, but in an algorithmic way, to the size of your trade with respect to the size of the total pool of the AMM. You pay as a liquidity taker fees that stays in the pool, and the liquidity provider, that was the actor that put the capital at the beginning, can withdraw the original capital and at the same time collect the trading fees that the liquidity taker have paid. So in some sense, you realize that you have built a financial market without an intermediary, and the fees are directly transferred to the liquidity provider. That is the actors that inserted at the beginning the capital. Let's say the drawback for the liquidity provider point of view is that they face the so-called impermanent loss. That is a possibility of losing part of the capital due to a dramatic movement of the ratio. For example, in constant product AMM, if the price is doubled or held, the important characteristic is that it's independent from the direction, the capital is eroded by something like 5%, to give you an idea. To have an idea of the relative sizes between centralized exchange and decentralized exchange as of today, I would say, we see that Binance, for example, that currently is the main centralized exchange, has a 22 billion daily volume in spot exchange, while decentralized exchange reached something like 2 billion, so about 10% of the total volume. But if you look carefully, there is the so-called exchange score that in some sense try to measure the confidence on the volume declared, because here you are realizing, and all the actors realize that centralized exchange have some kind of freedom in publishing the volume, because it's not auditable externally in some sense. On the other side, in the AMM, everything is transparent because lives only in the blockchain. It's transparent by design in two ways, I would say. First, because the smart contract that implements the AMM can be audited and is open source. And then, secondly, that is most important to our, in this case, is that all the transactions from the AMM and the LP or the LT are available on the public blockchain. The main characteristic is that middleman fees are completely eliminated and are redistributed among the liquidity providers. And as we said, the real big improvement is the absence of counterparty risk and informational asymmetry, because in crypto centralized exchange, there could be, let's say, some problem with asymmetry of information. On the other side, as usual, when there's a change, there are also risks. For risk, or let's say, I would say, weak points of the current state of AMM. Currently, the transactions on AMM are more expensive with respect to the centralized exchange. But to be honest, it's an unfair comparison, because in centralized exchange, as we said, they are just internal movement on the ledger. There's no the process of, let's say, consolidating the transaction on the blockchain. From the liquidity provider point of view, there is the so-called impermanent loss that could, in principle, overcome the gains that you have from fee collected. And I would say that in some sense we switch from a genuine counterparty risk in centralized exchange with what I would say code risk. It would be, let's say, in a usual way, would be what I would say operational risk. That is the risk that the smart contract has bugs, and could result in hackers trying to steal your money, but also an unfortunate freeze of all the funds that unfortunately happen in some cases that are never recoverable. And last part is that in principle, execution could be front-run if the mempool is, I would say, populated. Mempool is the set of all the pending transactions of a blockchain. And other actors could see your trade and try to front-run it by increasing the gas fee. And so being inserted in the blockchain before your trade. From the machine learning perspective, this represents an unprecedented set of financial data, because here you can, for example, reconstruct a complete trader history with full transparency. With full transparency, because you have the complete, let's say, pseudonymous identification of the counterparties. You can follow the trades that started from a single wallet through time. And so, for example, as Fabrizio mentioned before, in searching of trading signal, you can do the so-called supervised learning on conditioning on previously successful trading signal that has been recorded in the blockchain. Let's say a supplementary question that could be raised in this case is a true question that maybe is quite interesting from different perspective. Is it true that a single entity is behind every single wallet? And this question is handled in the so-called on-chain analysis, which a part of the on-chain analysis is the so-called entity reconstruction, that is utilizing unsupervised technique on blockchain data in order to reconstruct entities behind different set of wallets. This is a very interesting topic. A really interesting feature of the decentralized exchange is that, as we said, they are currently not competing on the same footing with centralized exchange. But the following question, that is a decentralized exchange can be a viable business, can be translated in the requirements on the underlying blockchain on which the decentralized exchange is running. And this is mapped in what is called the blockchain trilemma. It's essentially, let's say, a broad statement that says that a blockchain must have a fine-tuned trade-off between speed, security, and decentralization. And let's say up to one case, I would say, is always at the cost. When you want to increase speed, for example, you have to do it at the cost of decentralization. What is interesting to me, and that's why I joined the Algorand project, is that Algorand solved this so-called blockchain trilemma. And in the just more or less 1 month ago, we started the AMM on the Algorand. That is called TinyMan. Currently has a very small liquidity, 5 million of liquidity, but this is due to the limited number of the traded asset that currently is less than 10. But the market is growing on this. But the interesting part is comparing TinyMan with Uniswap. That is, let's say, the benchmark decentralized exchange on Ethereum. Transaction per second in Ethereum are 20 currently. Algorand is 30, but can safely scale up with the current framework to several thousand. And this is related also to the mempool. The Ethereum has 150,000 pending transactions on average, while Algorand is able to process virtually every transaction. And so currently the mempool is 0. But most important is that thanks to the, let's say, the underlying technology of Algorand consensus mechanism, the transaction fees on Ethereum are about $150 for a swap. While on Algorand, the equivalent swap is less than a cent, irrespective of the notional of the swap. And moreover, the transaction finality, that is the time that is needed for the transaction to be not reversed, in the Uniswap is something like minutes, actually, because if you want to go at 30 seconds, you have to increase dramatically the $150. While in TinyMan, with this 0.8 cents, is less than 5 seconds, usually 2 or 3 seconds. So the comparison is very interesting.
Sorry, Michele, yeah, because we are a little bit over time. Thanks.
Okay. I'm done. Thank you.
Okay, now if you want to conclude, you can show the conclusion. I mean, it's
Okay. Yes, I'm done. Okay, so just a sec. Okay, so concluding, I think that decentralized exchange offer unique opportunities for machine learning because they are producing an enormous quantity of data, but also a different quantity that could enable supervised and unsupervised learning techniques to leverage the data for, I would say, trading strategies and entity reconstruction. And the main gain is the elimination of counterparty risk that is traded off by a more exposure to what is called cold risk. Thank you.
Thanks a lot. We are a little bit over time, but if there is some question from the other panelists or even from the audience, I just have a very quick question. Do you think this is, I mean, this is going to be adopted also outside cryptocurrency swap in the sense, could you expect that the automatic market making could really change, even traditional, in quotation, financial market, or the incentive, let's say, to make this AMM are mostly related to, this counterparty risk that you were mentioning? So can you expect that, I don't know, stock exchange will be replaced by automatic market making? We have observed in the recent year a huge change in the market structure due to, change in regulation, fragmentation, and so on and so forth. Could that be also something that will be?
It's a good question. Do you think that it not applied to blockchain or cryptocurrency, but to usual stock, for example?
Yeah, for example, yes, because in principle you could do a decentralized exchange for I don't know, for stocks, not in principle.
Yes, I think in principle is doable, but here the decentralization of the structure plays a central role in the sense that what is the incentive of a centralized authority to define this way of making a financial market? Because there's no intermediate fees currently in the AMM, because the fees are completely distributed except a small fee that is acknowledged to the smart contract initiator, but it's very few, very tiny. So I don't think that there is an incentive, but except from this, technologically, I think that would be viable, and it would change the market impact that you know very bad structure, because there's no limit order book, so your impact is algorithmically determined. That is a dramatic shift from a liquidity taker point of view, because you know in advance what could be. And moreover, I've not covered this, but the constant product market maker is the starting point, but there are evolution on this. That is the master equation of the AMM could be changed in order, I would say, not to impact too much the liquidity provider, because impermanent loss, as I said, 5% for a 100% increase or decrease of the price is not that much, but could be an issue. There are different implementations in which you can tune the parameters of the bonding curve, that is the curve that gives you the final price, in order to reduce the possible impermanent loss.
Okay, thanks a lot. Thank you a lot for your presentation. I'm going to pass now the floor to Francesca Medda, which is co-central director in Consob. So let me make you a presenter, Francesca, so you can share your screen.
Thank you. Let's see if all the experiment works well. Okay, can you?
Sure, perfect. Please, the floor is yours.
No, I lost my screen. Sorry, it's classical things. Okay, let's see if it works. So I don't see all of you, and now so it's difficult to speak. I see only my presentation. But Fabrizio, it's fine. What can you see?
Fine. I did the same. It was also the same for me, so don't worry. Go ahead.
Yeah.
Okay, good. So thank you so much. Thank you, Fabrizio. Thank you to the colleagues, Michele, Daniela, Fosca for having me in this panel. It will be a different presentation from I suspect the others, because I didn't want to be very technical, and I wanted to tell you, since the conference is about tech share, I wanted to tell you what Consob is doing about a digital transition. So it will be much more general, and you wouldn't see any equation this time, but it will be probably next time. Okay, so I start immediately by observing something really interesting, given the fact that we are living in this very peculiar time. So I wrote these slides, and I was in my kitchen, and my sister is a lawyer, saw this word, inclusive finance, and he said to me, this is an oxymoron. It doesn't exist, an inclusive finance. In reality, if we think about it, that there are now in the world people that were recently, many years ago, not so many years ago, but unbankable, so unable to open a bank account, and now they are able to have a bank account to ask a loan, or sending money from their country to another country without spending so much. This is part of what we talk about when we talk about inclusive finance. In order to achieve inclusive finance, technology, and particularly digital technology, has really very much helped and support this transition. What I want to say is that in 2008 we have a major crisis, a major financial crisis. What we are experiencing still now with the COVID-19 crisis is a crisis that it's not only touch the financial system, but particularly the social and economic system, and of course the health system. So it's a bigger one, a much bigger one than what we saw in 2008. And for this reason, this is an opportunity for all of us to really change the way that we look at the financial market. So for this reason, I started with inclusive finance, because it will be an element also in this transition that we had in Consob. So really we have to put an effort between public and private sector to share this commitment towards the green and digital transition, because we want to have a different society when we look at the future in some way. So in this transition, regulator has a vital role. And because the regulator really unable give the framework of what the market, how the market has to work, and therefore also the links between the financial market and the real economy, and therefore people, which are the consumer, the people that have to be protected in some way, always by us, and the planet in general, because also that is an important aspect that we cannot give up, certainly. So certainly digitalization create a kind of a crisis for the regulator, because as you can imagine, digital transition and digital innovation are emerging very fast, continuous development, require rules to change, so require adaptation and evolution of the rules. But this is completely different from what was the procedure of a regulator, which is a procedure that started with a crisis, for example, in 2008, and then the creation of the rules. For example, Basel III, Basel IV, and so on. So usually this was the standard procedure of the rules. And it's a system that is very static. On the other hand, what we are requiring now, something very dynamic that has to change continuously. The other aspect that created some crisis to the regulator is the impact that some of these innovations are on the essential right of the citizens, like not only human right, but property right. Let's think of, for example, of the data, information of the data, but also access to some resources like electricity, water, and so on. So that has opened kind of a difficult elements for us in Consob, which we are, like many regulators in the world, we have to remember that our statutory objective are to safeguard the market, but also the people they save and they invest in the market. But on the other hand, keeping this statutory role, we have to remember that there is this booming wave of innovation, which are very important, that we have to support, and that because we have to support what will be the impact not only in the financial market but also in the economy seen as a whole. Now, the role of Consob in this innovation, I will call it as an experimental regulator. I'm here in Consob now less than 1.5 years. I'm seconded from a university, so I'm a professor of applied finance, and I've been seconded here at Consob just to lead this digital strategy. In reality, when I arrived here already, so it's not something that I've joined a transition, I joined a revolution. So already Consob was changing, and it's a change that is a bottom-up change. So it's something that is permeated towards through all the division here in Consob. So that is the very interesting aspect. But to do so, we have, the objective was to simplify our work, of course, here, the activity of all the people in the division that are working here in Consob, but also contributing to the growth of the financial market and the Fintech ecosystem. So these were the goal of the strategy. I wanted just to mention very briefly which are the core concepts of the digital strategy of Consob, which can be simplified or summarized with this acronym SMART. SMART, which represents these 5 elements. First of all, we wanted to see a strategy that had an approach as like a system approach. So we didn't want to look just really like a silos approach, really focus on one element, but we wanted to permeate completely the total concept. But also because it's a transition, it is a difficult transition, as I told you. We wanted to consider the risk. So the transition wanted to be step by step. So we create a strategy which was modular. So we move from module to module so we can verify. The other aspect important was adopting And I'm very attached to this word, because adopting for me in this acronym means that, as I said before, we want to adopt, every one of us is adopting this strategy. So it's not a strategy that I have created or someone else, but it's something that we have shared with all the division, and so it's something that is a co-creation, let's say, using a very fashionable word. The other points very important are that we have to resolve problem, so solve problem not only within Consob, so in our operation, but also outside. And I will show you now the experiment. And the other point, because we are experimental, we want to test. So we want to create software, algorithm, new module, new model, but like a tailor. So we want to create exactly for our need, and so we will test it, we will verify, and we test it and I will show you also this element as we go to the next slides. Okay, so sorry, it's very ugly. I observed it yesterday. It was very ugly. I've done it. I'm not very good in designing, but so apart from the designing, this is a representation of Consob. It's not a very good representation because the core of the Consob are the two elements that are very small. The little rectangular are all the divisions, so these are where the activity of Consob is done, and then on top the board of Consob. So what you have on the center is what we have called digital nexus, which actually is not a division, is not also a project. So we are starting everything, and this digital nexus have two legs. One, and say, is like a Janus god, has two faces. One, they look outside, which is called Consob Tech, and one, they look inside, which is our lab, the Digital Innovation Lab. So I will describe briefly these two because I would like to show you the project that we are carrying on in both sides. So let's go first to the Consob Tech, so the outside vision of digitalization of Consob. And here we have Consob Tech with two activity fundamental, which one is the sandbox and the other is LiftTech. So of course we are looking towards the growth of the fintech ecosystem, not only the ecosystem, so not only fintech Italian, but also foreign fintech companies that want to work in Italy. We have two activities, two main activities. One is the sandbox, which we have started in 15th of November, so we are very new. So in the 15th of November is the opening of the windows to apply to the sandbox, to the regulatory sandbox. The sandbox is run by Bank of Italy, IVAS and Consob, so is a specific, a little bit different from, for example, the sandbox of FCA, but because we have the three authorities running together. What is a sandbox? Is a place, is a virtual place in reality, where companies that have a new innovative operation or service in the financial system, so fintech company can enter and can be controlled, checked and supported by the three authorities. There is some leeway so in the rules sometimes, so that is one possibility, but the greatest possibility is to experiment your new innovative ideas, new products, new, let's say, operation with the three authorities helping you, supporting you, and control that you are following all the compliance, all the safety necessary. The other activity that we do in Consob Tech is called LiftTech, as you can imagine. The idea is to support fintech industry when they want to enter in the market. We do, above all, support through the dialogues. Is a dialogue so that we do either with the to help you to enter in the sandbox, or either if you want to start an activity. We give information in Fintech, and also we give support to companies that want to use Fintech application in their operation. So that is we are also going to enter in 2022 inside the accelerator of CDP Venture. So we will do different activity as Fintech. As you see, the idea is to be, the concept of ConceptTech is to be like an origami. So we will help we will help the industry to create the origami that they will prefer and they will dream to achieve. Now I go very fast to the next part, which is in some way more interesting, for example, for the university, which is the R-Lab. In the laboratory, here you see, first of all, the fundamental problem for us was that we have to create a new rules. We have to create a new model in our operation. And the first point was to remember that digital innovation are particular digital innovation that we have to supervise are sometimes they don't have boundary. They go through country and another country. So the first point that we wanted to remember was that we have to have international collaboration to exchange algorithm, to exchange best practice. So you see first on top ESMA, which is the European agency that coordinate all the agency like CONSOB. So we are creating a lot of exchange also, for example, of algorithm that we will like to exchange it with other authorities. So first of all, this harmonization important in the rules, and then the other part, then the other aspect, which is the transversality of our all experiment. So you saw down the big lab, the big rectangular, the small one, which are the division. So all the activity has to be, they have to cover the transversality of everything. So not anymore a silos approach, but an approach that goes through all the division. And in doing so, we have created also collaboration. Of course, the first collaboration with the Guardia di Finanza, which you can imagine the connection, but another big collaboration is that with Consiglio di Stato, on the part of exchanging experience, exchanging algorithm, exchanging best practice. The other point, which is that point is interesting to Fabrizio also, is the collaboration which we have with the Ministry of Research. We wanted to do all this innovation, as I said, at the Big Four, without taking out of shelf our model, but creating this model. And therefore, we have created this program with the university in order to create it, not only sponsor PhD students, but also create a program where we sponsor internship industrial PhD within the CONSOB. We started with the first two projects, which are the two pilots. 1 and 2, one the classification of analysis of financial product and manufacture. This is we needed to automatize the analysis of 100,000 of kids. The kids are the information that we receive from the intermediary in relation to products, to the products, financial products. We receive, as you see, in 2020, 9,000 that have to be usually are PDF files that have to be from which we have to extract the information, and the information useful for supervisory, but above all have to be make analysis of that. So we are running this project with machine learning again. And the other one is market manipulation with a division. So the first one is the division of intermediary. The second one with the division of market is related to market manipulation. So in some way now I relate with what Fabrizio was saying. And the project is divided in 4 elements, but let's say the fundamental one is really the predicting predict market manipulation and misconduct behavior. So that is completely new, because we are talking about predictive behavior, predictive also activity as a regulation and as a supervision. So predictive supervision is kind of new, really very new for Consob. These two projects are run with two universities. The first one with the Sapienza of Roma, leading is the Professor Lanzerini. On the other hand, the market manipulation is with the Normale di Pisa, and leading is Fabrizio. So it's something that we run. So thanks Fabrizio for this. And today we have the first meeting here in Consob with the researcher, with everyone here. What I wanted to say, which is very important for me as a researcher, but also as Consob, because we are new in this world, these two projects were selected for several reasons, but for me were important also because they look at AI, so artificial intelligence, from two points of view: the ontology and the epistemology of artificial intelligence. We are very much focused on the epistemology of AI. All of us are working, and me as a researcher, we are working on that aspect. But it is very much important also to look at the ontology of artificial intelligence. And these two projects, the project with the intermediary is an ontology, very much more ontology project, and the project with Fabrizio more an epistemology one, because perhaps our future, when we talk about artificial intelligence, will be an hybrid system between these two approaches that at this moment are sometimes one look in contrast with the other. I'm almost finished, and in my conclusion I wanted just to say that of course financial innovation promise us a lot of benefit for society, but of course they raise a lot of threats, and we cannot forget these elements. And it was interesting to hear the colleague from Algorand, because we had quite a lot of discussion, particularly with Silvio Micali, about the threat and how an authority like Consob has to look at the new regime, a new pilot regime that will open soon on DLT. So in this case, we are looking at really at a coin. Of one side, as Consob, we have to encourage technology and innovation. On the other side, we have to look at the problems that so many problems that we have, from blockchain to robo-advising to credit scoring and so on. So we have to consider all these problems, and the two sides are important for us. What I wanted to say, however, of our role is. I'm finishing.
A little bit over time. Yeah, exactly. Thank you.
Yes, I'm finishing. Don't worry. I'm finishing. Regulation provide certainly not only boundary but legitimacy, and we cannot talk about regulation without thinking really the role of the regulation as developer of and providing confidence to the market and to the financial system. So our role is, I hope that is important for all of you when you think about the new innovation and so on. So I conclude now by just reminding the three elements very important for us: experimentation, transversality of all our innovation, and international coordination. Thank you very much, and this is my emails if you want to speak, you want to ask me after any questions. Thank you. Sorry if I went beyond. I have trained, and it was 15 minutes exact. So sorry, Fabrizio.
It's always this way. Thanks a lot, Francesca. I mean, we are really a little bit late. So if there is some quick question from the panelists, otherwise I will go to the next one, because
I left the email so they can send the question also to me directly.
Perfect. Okay, so the good bridge, let's say, with the next panelist is because you are discussing about some of the activity we are doing in the quantitative finance group at Scuola Normale, the collaboration we have together started together on market manipulation. So this is a good bridge for the next speaker, which is Professor Fosca Giannotti from Scuola Normale. Fosca, are you there? We cannot see
you. Can you hear me? Can
yes,
you hear
we
me?
can hear you. Yes, yes, yes.
Okay, now let's.
Yeah. So Fosca is professor, is the first professor of computer science at Scuola Normale. Very recently took this position. So she's an expert of AI and data science. She will more about AI.
Sorry, you already see my screen. So
yes, we see everything is perfect. So we'll have a view about let's say I guess what the competence in AI, explainable AI, especially at Scuola Normale. So Fosca, the floor is yours.
Okay, so thanks. Sorry for interrupting you. And actually, indeed, my contributor will be trying to give a sort of overview of the new directions that artificial intelligence it's tackling for creating the trust which is needed for in many critical situations, as we were saying before. Not for manipulating the market, but preventing manipulation. I hope it's so. And this is what will be for doing this, we need a technology which we can trust. And explainable artificial intelligence, it's a really crucial aspect for preserving the people's autonomy of actions. I will try to give you some hint about this path that we are trying to do as researchers, but not only as researchers, because there is also a path in terms of regulation in Europe that in order to push the uptake of AI in any possible commercial and social life situation, we need really to create an ecosystem of trust. So and okay, so so the vision that Europe for artificial intelligence that Europe is embracing, but also that I'm sharing a lot, is the fact that we have to go towards in a direction of an artificial intelligence which is we call human-centered, so which is respectful of human right, both at the individual and the societal level. And we have to do our best effort for pushing ethical principles within the AI systems. And those are the driving principles also of the new regulation. So in design systems which are beneficial for humans, to make humans that are capable of making humans more intelligent in their decision-making process, which provide the autonomy and justice, of course, in the rule of law, no maleficence. And there is one important fifth principle, which they have to be explicable. Explicables, that means that in the two dimensions that this words incorporates. One is the intelligibility, so that means capable of explaining how they work, both for non-expert and for experts, for the engineers, the data scientists, with taking into account the different background of the potential stakeholders of the AI systems. But also the other dimension is accountability. Who is responsible for? And the intention of having those principles incorporated and in the AI systems, which will be part of the EU market, it's really one important issue. So there has been a group, a high-level expert group, which has worked for more than 1 year trying to define requirements that such AI system should have, in order that have sort of accomplished those ethical those ethical principles. All of you know that also GDPR in 2018 started to insert a sort of seeds in the direction of having for those systems which are some automated in decision making, where individuals are involved. There has to be respected the right of explanations. Again, as I was saying, the EI Act, which is currently under discussion, so define a level of pyramid of risks that an EI system might have. So that means that in the design process, those risks have to be evaluated, and there are some unacceptable risks. That means there will be EI systems that cannot be commercialized in Europe, and there are systems which are high risk, like recruitment, medical device, credit risk, and there is a collection of potential high risk example of high risk that have to be satisfy a set of trust requirements, those that I was saying before, including the transparency. And so why there is this big worry about the fact that EI can inhibit human actions. It is important that we go in a direction where EI, there is the human oversight. So, but there are situations, and just I give you a couple of examples, both at the societal and at the individual level, for which EI may create, there are traps in the EI technology. For example, we are used to recommender system, which they works very well at the individual level. They provide us the things that satisfy our confirmation bias, and they are very successful for the business of the platform. But there is some risk in that technology. So in some sense, they force conformity, and forcing conformity in some kind of applications may be risky at the societal level. One example is in traffic. And traffic, of course, if in case of a danger on a path, all the citizens, all the drivers that will have to reach that point have the same suggestion, the same recommendation of going in the same other directions. So we simply move the problem from one side to another side. So what is beneficial for the individual? So I will have I will avoid the problem on route A, and I choose route B. But if all the drivers choose route B, their individual optimal will be not a collective optimal solution. So, and that's one of the reasons also for in the misinformation on the bubbles, on the creating of echo chambers, where we all stay in the same with the same friendship, with the same opinion, and this creates a sort of it amplify the polarization. And there is another kind of risk, which is on the data side. So we know that machine learning learn correlations from the data. Of course, they learn what is on the data, and so there might be. And if we have machine learning systems which are trained on data which have such bias, and we are not aware of bias which are there, and we do not provide such bias in forms of explanations to the end user, if there isn't any explanation to end users, we hide those bias, and there may be very unpleasant situation. Compass is one of the most famous one, where the judges were provided with a high risk, which was strongly influenced by a majority of population in jails, which was the black people. So systematically, there was provided a higher risk of recidivism to the bites. I mean, the algorithm was learning by the data, where there were this difference in the distributions of populations, of course, and this was reflected in the recommendation. But if there isn't any further explanation about the logic which was included behind, even on so the judges was, or the judges simply demand the decision to the algorithm without having any doubts, or the judges has doubts and then does not trust the technology. So in both cases, we haven't reached the ecosystem of trust that we want, because we want systems which help in taking better decisions, not replacing the humans, but putting them in conditions of using their critical sense. So there are plenty of critical situations where we don't want to replace the human decision making. We want to help, but of course, even humans may do mistakes, because they may be maybe they may have prejudice as well. So there are moments where it is important to bring more knowledge by the autonomous, the intelligent machine, but it is important to preserve this capacity of acting. This is the topics that we are taking in this ERC project that I'm doing here at the Scuola Normale, trying to focus on the explanation which is needed for supporting the human the decision-making process based on AI, with an interaction between human and the person. Of course, it's very difficult because there isn't an explanation that fits for all. It strongly depends by the user that we have in front. So and the users might have different goals. So the end user want to know, am I being treated fairly? The engineers want to know if the system works as it was designed. The regulator, is the system compliant? So, and that means that ideal explanators has to take into consideration the context, the user background, which becomes an important part of the system. There are plenty of different flavors in the different AI fields. So there are plenty of a tentative of providing explanation for inspecting the system, the machine learning systems, providing to the designers what are the important features, the relevant features which have mostly contributed to a specific prediction. And then those are useful for the designer, are not useful for the end users, but they are a good starting point for building a narrative for the end user. So are just a good interface going towards the end users. Narrative as a story, combining media, image information with the narrative. Again, this is possible if we are capable of mapping the learning process with some more sophisticated elements, maybe in a knowledge graph, which more semantics, so we can map the machine learning process with augmented with semantics the various steps of the learning process. Or another important area is the one producing explanations with logic rules, but in terms of factual and counterfactual information, trying to activate the contrastative information. This is the case of several a line of research that we are also following, for which we have done several methods, where simply you try to provide an explanation in terms of for an individual request, an individual prediction. You try to provide an explanation which enrich with the explanation with the set of motivation, and also with the set of what if analysis, things that can be changed for obtaining a different outcome. So this is an example in the case of a credit decision.
I cannot hear Fosca. I cannot hear you anymore. La sentite? No?
Mi sentite?
Ora sì,
Mi sentite?
Sì. Yes, sì.
I don't know what how much do you lose.
5 steps.
Okay, did you were here with me?
Yeah.
So, okay, about counterfactor, another form of explanation. There was an example of counterfactor for a credit, declining a credit, system declining the credit, the motivation that several features were too high, other features were too low of that specific client requiring a credit, and then some other features required to change. So activating a sort of what if analysis in the users, which is a very important in there. But the ideal what we are working is having an explanation as a conversation, a human machine conversation. So the black box, the model machine learning models proposes a recommendation. Then the user asks questions, and then can be the request may be in terms of factual and counterfactual reasoning, but also in terms of some causal, showing some causality, showing similar instances, starting a sort of interaction of several questions. That means that we need to also to change the machine learning itself. So there is research there. So this is the taxonomy of methods which are there. There are methods, explanation methods which are transparent by design. There is plenty of research working designing transparent by design. Other methods are called post hoc explanations. So try to stay with the black box and construct explanation out of this black box with an auditing system. It is interdisciplinary because, as I was saying, once we pretend to put the users in the loop, that means that we have to design systems which are capable of understanding the users as to be put in condition to understand the machine, but the machine is to understand the users. So, and the user with the context, with the sensitivity, with and this implies that it's not anymore only artificial intelligence, but we have also to integrate with other disciplines like human computer interaction, social science, as well psychology, cognitive psychology. But of course, those are the research frontier, and sometimes those research frontiers are confused with what should be, even with current technology, a good design. So we have, and this is already there. We don't have to invent the fact that we cannot set up a workflow, an analytical workflow process without doing the appropriate, well-designed steps. So bias discovery, discrimination discovery. So all those things have to be there in the steps. So bias statistics. So that means that some of the things of good design are already there. We cannot say that we are still to wait. So that means that in this human vision of human-centered AI, if we want to design systems which are beneficial for individuals and society, we have to have a different approach to AI. So we call it a responsible AI. So of course, our system has to be interactive, autonomy, adaptability. Those are things that we need to redesign the algorithms for this. But we need also to provide transparency, accountability, and responsibility. That means that we have to rethink our design process. Some of the things are already there. So ensuring the development process takes into account ethical and societal implication. So evaluating the risk is not something which is to be considered an extra cheers. It has to be really part of the design of the responsible design process. We can also be more sophisticated, including also ethics by design. When we were saying before that our recommender system have this risk of amplifying some negative issues at level of the network. Maybe we can start to think to insert different objective goals in the maximization function of our machine learning models. And again, a responsibility, so the designers have to be responsabilized because and we need also certification mechanisms, and those ingredients are really in the new act. So I think I'm hope I stayed in the 15 minutes. I'm open for questions. This is activities which is pursued in several European projects, and we are trying to expand, create the community. Also, we are trying to find, at least for explainable AI, to find the use cases where we can demonstrate that such a responsible pipeline, design pipeline is possible.
Thanks a lot. Yeah, thanks a lot. Again, we are a bit over time, but if there is,
I don't know how to.
Oh, don't worry. I mean, yeah, if there are other questions, because otherwise, let me pass the floor to Daniele. Right, so make Daniele Regoli presenter. Daniele is a senior data scientist at Intesa San Paolo. He's also going to discuss about fairness. Okay, Daniele, now you are the presenter. I see the slide. Yes, it's okay. But you are muted, Daniele. Sei, devi unmutarti. Non ti sentiamo. We cannot hear you because you are muted. I unmute you. No?
Okay, now can you hear me?
Yes.
Okay.
Please.
I was muted by the organizers, so I couldn't do anything about that. Okay. So you see my screen, right? Okay. So, but first of all, I want to thank the organizers, in particular, thank Fabrizio for inviting me to speak in this webinar. Yeah, I'm going to talk about fairness in artificial intelligence. So something that actually Fosca has touched upon briefly a moment ago. So first of all, why do we talk about fairness in artificial intelligence? Well, Fabrizio already said briefly in the introduction, and also Fosca mentioned it, but let me focus a little bit more on this. So what we have now, okay, this is a funny picture by Maurice Hart. Maurice Hart is one of the big names of fairness in machine learning. He's professor at Berkeley. And this is a picture of 2017, but actually things got even worse in the subsequent years, worse or better in some sense. And really the field of fairness machine learning has boomed in the last 5 years at most. So as Fosca was saying, the problem is that machine learning can represent risk for people. So in what sense? So of course you all know that machine learning learns patterns from data, of course. And the point is that if this data contain biases, and typically they do in general, because data are collection of information from human behavior, social behavior, so they at least can contain biases, then machine learning could learn these biases and perpetuate or even amplify them at scale. And as Fosca was saying before, it could do this also in ways that we don't understand. So in this respect, fairness and explainability go hand in hand, because if you cannot explain, if you cannot understand what the algorithm is doing, then the problem is even worse with respect to bias. But it can also happen that you don't have bias in data, but you simply have minorities. So you have a small group inside your data set, and because machine learning actually learns by statistical methods, it could learn to disregard this group simply because it's small. And so it can also produce bias when there is not in the data. So this, as you can imagine, can have huge impact not, of course, in all uses of artificial intelligence, machine learning, but at least in some specific use cases. For example, I've posted here just two examples: recruiting and credit intermediation, so loans approval, credit lending in general. So if you have risks for people, of course, these risks impact companies as well. Companies sell products to people, sell services that people use. And if these services are built with machine learning, they can impact people, and thus they can impact companies. So if you do a research online, you will find now dozens of examples of companies, big companies, who had some problems with ethical aspects when using machine learning. I've here just posted here a few of them that I found searching online. So Apple had problem with the Apple Card because its algorithm was actually gender biased. Amazon, AI tool to hire people, so recruiting in this case, had to shoot down the algorithm because it was, again, gender biased. This is machine bias. This actually is what Fosca talked about before, the compass problem. So this algorithm compass, which is used to predict recidivism of criminals, was actually found to be biased with respect to the color of the skin, black versus white. And actually, it has become kind of a case of study in the fairness literature because it has nuances in the definition of fairness with respect to which you can claim that the algorithm is actually discriminating or not. And then I've put here also the problem with Google is this is kind of an indirect reputational damage, let's say, because you may have heard that in 2020 and 2021, so this year, two of the leaders of the ethical AI group in Google actually were fired. The leader, Tim Gebru, and the co-leader, Margaret Mitchell. Actually, they claimed they were fired. Google claimed that they quit, actually, but the reputational problem still is there. And the problem raised because they criticized the trustworthiness of some Google natural language processing algorithm, machine learning algorithm. So even if, apart from these reputational problems that companies may have, there is also regulation. So as Fosca already said before, in April 2021, the European Commission put forward a proposal for a general regulation of artificial intelligence. This is the very first example that we see in the world of the regulation that tries to regulate in general the artificial intelligence world. And in this proposal, which is not yet in force, but it will be in the next future, there are parts of this regulation, this proposal for explainability, as Fosca said, and there are also parts for bias and fairness. I've just posted here the article 10, which is on data, which kind of in an ambiguous way, but it says that you have to do an examination in view of possible biases. You have to check for suitability of the data set. You have to check for any possible data gaps, shortcomings, and say how you can address those problems. So this just to say that in the near future, companies will have to will be obliged to deal with bias, discrimination, and fairness in the next future. So, having said this, let's come to what I think is the trickiest point of all this matter. That is, what does it mean to be fair? So, I'm sure that if you stop and think a little deeper about it, you will convince yourself that you really don't know what yourself mean when you speak about fairness in general, because it's easy to say that we want to be equal and we don't want to discriminate. But if you try to put it in real cases, then you understand that there are really different concepts and you don't really know what is the right one to choose. So in order to, so again, as I was saying, if you look in the literature on fairness in machine learning, but also on fairness and bias discrimination in general, you will find a lot of different definitions. I put here these three for the sole purpose of convincing you that the situation is complicated. So under the big umbrella of the concept of fairness, you actually have different concepts, and each of which has specific characteristics. And if you target one of them, you are losing something in the others. I'm not going into the details of all of this. I will just focus on the clash between group and individual fairness. Which is a clash. These are actually not two completely distinct concepts. It's it's more of a range, more of a gradient between a full group definition, which is called demographic parity. I'm going in a minute to explain this with an example, to the other extreme, the individual extreme, which is called fairness through unawareness. So let me do an example to try to explain what these two metrics are. So let's make an example. Let's make an example on the financial sector, so credit intermediation. So we want to build an algorithm that decides whether to grant or not a loan to applicants to loans. So when assessing fairness, we always have to decide what is the dimension with respect to which we want to assess fairness. So, and typically they're called sensitive variables. It can be gender, for example, if you want to be sure that we don't discriminate, for example, women with respect to men. It can be age, for example. It can be ethnicity, as in the Compass case, so black versus white. In this case, I took citizenship. So just as an example, I'm focusing on home citizens and foreign citizens that go to a bank and ask for a loan. So fairness through unawareness, which is the most individual definition of fairness that you can find, says, okay, I don't care about anything. Simply don't use that variable in your algorithm. So don't use citizenship in this case to take a decision. So in this case, if you have two people, one which is a home citizen and another one which is a foreign citizen, and they are equal in every other respect. Here I put financial status, but you can think of any other variable that they can use. So they are equal in every other respect, apart from the fact that one is a home citizen and the other is not. I want to give the same decision. And in this case, it's called individual fairness. So similar people are given similar decisions by the algorithm. This may seem intuitive. It seems intuitive to me. It seems reasonable also. The problem is that it can be fooled very easily. You can do it very easily by inserting in the problem another variable which is correlated with the sense, in this case with the citizenship in general, with a sensitive variable, and you can use it. So you are not using explicitly citizenship, but you are effectively using it. For example, you can think to include in the problem the zip code of the so where these people live, which is typically correlated with the citizenship and also correlated with financial status. So you can effectively use the sensitive variable even if you don't explicitly use it. The other definition, which is the other extreme, this is a pure group definition of fairness, is called demographic parity, and it says I don't care of anything. Unconditional to get anything else, I want that you give the same acceptance rate, so the same acceptance rate for loans, in this case, to home citizens as you do for foreign citizens, same acceptance rate. So if you have 50% of loans granted to home citizens, I want that you have 50% of loans granted to foreign citizens. So in this case, you are doing exactly the opposite as before. If you have in this case, you must have two people. If you have two individuals with the same financial status, one is home and the other one is foreign, then to these two guys you are giving a different outcome. This is rejected and this is accepted for the loan. And you have this disparate treatment in some sense because exactly because you want to reach an equality, a kind of horizontal equality, unconditional on anything else. So this may seem extreme. Again, this at least to me it seems a little bit extreme, but I can assure you that it's something. This is the most used definition of fairness in general, and it's also well known in the literature as the 4/5 rule, first put forward in this regulation guidelines for employees or in the recruiting sector. 4/5 rule because this rule says that the acceptance rate of the unfavored group, in this case the foreigners, should be not less than the 80% 4/5 of the acceptance rate of the favored group, in this case the citizens. So, I've just tried to explain two definitions of fairness. There are plenty of them. There are many more of them. Demographic parity, which has the problem, at least to me, that it is a bit extreme because it's unconditional on any other variable, and it makes sense, at least to me, only when you want to enforce some kind of fairness that you think that in principle should be there. So you are saying that if there is a difference in these two groups of people, men, women, black, white, home, foreign citizens, it's a difference that it's caused by historical biases, so you want to fix them, so you impose equality. On the other hand, fairness for awareness has problems. It seems more intuitive, at least to me, than demographic parity, but it has problems because it can fool it very, very easily. So maybe the best thing to do, but this is my opinion, it's not something that you find in the literature. The best thing to do is to use some variables and not others. For example, in the case of credit lending, of course, at least for me, it's fair to use the financial status, even if it is correlated with, for example, gender or citizenship in this case. But maybe it's not fair to use the zip code because you're kind of trying to use citizenship in disguise in some sense. But this is the entire problem. So you have to choose what variables it's fair to use and what variables it's not. And this is not something that, for example, in the regulation is not specified, and nobody tells you what is the right choice. And this is, for me, the biggest problem, at least at the moment in this issue. So there are others definition of fairness, as I said. I think I'm going to skip this part. I think that you will have the slides anyway, so you can go deeper if you want. You're welcome to, of course. There are other definitions of fairness. In particular, there are definitions that don't look at acceptance rate in different groups, but they support the equality of error rates in different groups. So you claim that you want to have the same error for women and for men, for example. These have problems too, and these slides work to focus on this problem. But since I'm running out of time, let me just skip this. Okay, there are mitigation strategies. So you can find in literature, in the research, in the academic research, there are mitigation strategies. So there are ways to prevent an algorithm from discriminating. These are techniques that are usually divided into pre-processing, in-processing, and post-processing, depending on the point in which they focus. So pre-processing remove bias directly from the data set. In processing, you train a model that during the training process, you ensure that the algorithm don't discriminate. And in post-processing, you actually do it exposed. So you tweak actually the thresholds in order to have no discrimination in the problem. But of course, the point is that you need first to decide what is the definition of fairness that you want to mitigate with respect to, and that's the problem I was actually mentioning before. So 30 seconds just to say what we are doing in this respect in data science and artificial intelligence team in Sao Paulo. So we have been working on this for 2 years now, on fairness and explainability, and we have embedded the assessing of fairness and the mitigation, if necessary, in the project design of any project that we develop. We are doing research collaborations both with companies and with academic institutions on these topics, and we published papers also on that. We are trying to foster the awareness, particularly inside the group, but also outside on these topics. We've done advocacy, we do advocacy activities with the European Commission and also with European trade associations in this respect. And we also, as a data science and artificial intelligence team, we have developed and proposed a set of high-level ethical principles for the entire group, a kind of ethical code. So I think I'm done. Yeah, I've put here just some references. If you want to go deeper in the topic, the first block is references of surveys on metrics, on biases, and in general in the problem of fairness in machine learning. The second one is a topic that I just very briefly touched upon, but at least in data science, it's maybe the most interesting one, which is how to do bias mitigation. So these are the three top papers. The first one on the pre-processing techniques. This one is on the in-processing technique, and this one is on the post-processing techniques that I've mentioned before. So I guess I'm finished. Thank you all of you.
Thanks a lot. Thanks a lot. So let me share my screen because we are a little bit ahead of schedule, and just try to be fast and show you. So show my screen. Okay, so I think you see my slides. So I'm going to just to give a very brief review of the activity of the quantitative finance research group at Scuola Normale Superiore, where I'm partly working. This is the group. The group is composed essentially now almost like 4 faculty. One will be hired soon. We have 4 postdocs. We have 15 PhD students. And we have a vision of, let's say, a mixture of theoretical and empirical approach, an interdisciplinary approach to finance and economics by using tools from mathematics, computer science, and physics, and of course, a twist toward, let's say, analysis of big data, and more recently, in using artificial intelligence. We actually had a lot of interaction. We have a lot of interaction with the industry and the regulator. This is a list, let's say, of funded research by the companies and also by regulators, and also interaction which are just scientific collaboration that we have or we had in the past, so on very different topics. This is a list, let's say, of research areas where we are active. Definitely, and I'm going to show you, few spots of them. So one clearly is high frequency finance and market microstructure. Other are related to portfolio, systemic risk, mean field games, firm evaluation, and in general, time series, I would say, is one of our main skills. Also, deterministic time series and stochastic time series, and of course, also the use of time series with machine learning and artificial intelligence with application to finance. As I told you, one of the main topics we are working on is about market microstructure and high frequency finance. So essentially, one of the topics we are working on is try to model and use very, very high frequency data, essentially coming from the limit order book. Michele already mentioned the limit order book. I'm here showing a plot from a snapshot from the Coinbase, which is again a crypto exchange. Okay, so typically, the limit order book is the place where all the order to buy and to sell arrives very dynamically, very high dimensional. Building forecast out of it is very complicated. You need to also, because typically you have to do this in real time, and this is critical in many trading problems ranging from algo trading, optimal execution, and market making, which are all topics we have worked now for many years and we are still working now. Just to give you an example, this is something we have been working and still working in collaboration with some company, which is essentially using machine learning and artificial intelligence to do short-term prediction of price by using the information about the limit order book in real time. So essentially what we do, we train machine in order to forecast where the price is going to go in the future, using, in this case, you see neural network, but more generally, we obtain the same also with other machine learning methods. This is something we are especially interested in, is related to the problem of, as I was mentioning, detecting when the system change in real time, not maybe like the COVID, but let's say on a shorter time frequency. So we are particularly interested in modeling which are able to detect the change in regime, okay, regime shift, this would call it. I mean, this is an example of a paper using, again, machine learning and artificial intelligence method, particularly gradient boosting and temporal mixture and some model for predicting intraday volume in the cryptocurrency market. And the idea is exactly to use information coming from different sources, in this case, different market where this exchange takes place. And the model is able to detect at each time, essentially, which is the variable, which is the set of variables which are more predictive for what you want to do. And this clearly outperforms out of sample methods, which are instead using, let's say, fixed parameters in some sense, that do not try to adapt to changing market conditions. You see in the bottom, you know, the contribution score, which is of given set of predictors, which is changing through time and allowed to perform better predictions. Another area of interest apart of high-frequency finance is the role of information and prices. You know, one of the, as I was mentioning in my initial presentation, one of the ideas is to collect to make semantic analysis of automatic semantic analysis of news, tweets, whatever, text in blogs, whatever you want, in order to get information about what is the topic, what are you talking about, especially if this is a good or a bad news. This is what is called sentiment extraction. Okay, so you want to extract sentiment from this, and then try to see whether sentiment is predicting financial prices. Okay, at long term, but especially, let's say, at short term. What is the problem? One of the main problems is that even if you have a very good sentiment analyzer, what we observe is that the signal is extremely noisy. We have noticed this in a work we did many years ago in collaboration with the laboratory of Yahoo Finance, where we had information not only on the news which were published in the portal, but also on the number of clicks that the published news was receiving about the news, or how many people were reading actually this news. Okay, and what we found is that indeed, even if you take a very capitalized stock, well, essentially what you observe is that there is a very big heterogeneity of the number of clicks that the news receive. For example, this is a plot. No, sorry, I don't have the plot here, but there is a plot where you can show that indeed there are some news for a given company which does not receive any information, and other which receive a huge number of information. So clearly, if you don't know this, and if you include all the information in your sentiment analyzer, you will include a lot of noise, a lot of irrelevant news, either because they're already known by the market, or because they are not so relevant for predicting returns. So the idea, in some sense, was to say, okay, let's test if this is true by using the special data from Yahoo Finance, by trying to use this weighted sentiment, which essentially is the sentiment of all the news weighted by the number of clicks. So we weight more the information which are more important and less the ones which are less. Of course, in a causal way, okay, we're not using information about the future, but essentially this in real time. And what we found, essentially, even if I don't enter here, by using some causality test, is that you improve a lot the predictability of return by using sentiment if you correctly weight the most relevant one. Okay, so really weighting the most relevant one make all the difference. And the reason is exactly because a lot of news are irrelevant, or they are already, let's say, incorporated into the market. So this is a very nice result, but unfortunately, very often we don't have this information about the relevance of the news and how to denoise news from this. So we are trying now to tackle this problem on a different perspective, which is essentially denoising sentiment, and try to see whether this is relevant for portfolio allocation. So essentially what we did is taking, let's say, market available sentiment signals, for example, the one provided by Thomson Reuters, and essentially we develop a model where we assume that this is a noisy version of the true sentiment, and we try to denoise it also by using a multivariate aspect, which means denoising simultaneously the sentiment of many different assets, and then try to build essentially a portfolio based on this sentiment, okay, so predicting. And what we found is that the portfolio allocation, not intraday, okay, it's a portfolio, it's a dynamic portfolio allocation, which is obtained by using a denoised sentiment, outperform clearly in terms of Sharpe ratio, Sortino ratio, the portfolio of other that you would get by using the naive, let's say, the raw sentiment that you get from the data vendor. So it's extremely important, let's say, exactly for this reason of the noise, to remove this information from the market. And finally, because I don't want to take you too much time, it's already noon and we are almost done. Another example I want to mention, which is completely different in a way, is related to payment network and credit risk rating. This is something I was mentioning in my initial talk. The idea, okay, we know that credit scoring is very important. Typically, credit scoring is obtained by looking at the balance sheet or data of the individual company. Our idea is that what's more important in order to get credit scoring is to know who are your partner, okay, your business partner, either your supplier or your client or the one with which you have an alliance or whatever, right? So the idea is essentially you can think a company as building a sort of network where there is an arrow. The arrow can represent a payment, can represent some alliance or something like that. And then the question is, how much are your neighbor informative of your risk? So can we essentially improve the prediction of risk of credit scoring of a company, not only by looking at the financials of the company, but also by looking at of the neighbors? And essentially what we did, one possibility to do this was obtained by one of the business interaction we had with UniCredit, which provided us the corporate payment network. So this is a network composed by 2.4 million companies in 2014 and 47,000 million payments done within the year between companies through the payment platform of UniCredit. So essentially, you know, if there is a payment, that there is a relationship between business relationship between the companies. Okay, and then we have some information about the risk rating. And then essentially the idea was to say whether the local property of the network of the node are predictive of the risk of the firm. For example, the number of customers, and the size, of course, of the customer of the suppliers, or if there is some sort of assortativity, which means that companies which are similar in credit scoring tend to do market together, or even at a global level, in sense that maybe you can divide the network in communities, and each of these communities is homogeneous in a way in terms of credit scoring. And we found actually that all these are true. I'm not going to show you this too much in detail, but for example, we clearly find that when you take the network, this very big network, and you try to find communities, so group of strongly interconnected nodes, they are typically more similar in risk that you can expect. So if I know the group to which you belong, I know something about your risk. So essentially, the bottom line is that your neighbors carry a lot of information about the risk level. So now, once we found all this correlation, let's say, between the property of the network and the property of the risk, we can, of course, make the opposite exercise, try to see whether we can use all this information to improve, let's say, the credit scoring. And the answer is yes. So essentially, we develop a classification method that we're using not only the usual information, but also information about the network, okay, the number of connection, the risk of the neighbor, position in the network, to which community you belong, size, you know, a lot of predictor, and then try to use some machine learning method, neural network, for example, in order to be able to predict what is the risk of the company. And indeed, we found that we improve with existing method, which means that having this huge amount of data and finding this correlation can help improving your credit scoring. Right, so that gives you an idea about both the interaction with the industry of our group and about the type of work that we are doing. It's very fast, but it's noon of 5. Of course, if you have any questions or you want to know more about our research activity, you can connect to our web page or contact me, and we can discuss, of course, about possible collaboration. Okay, so I can stop sharing my screen at this point. Okay, I don't know. I'm asking now the organizer what, but I think now it's past noon, so maybe we can. If there are no questions, which I don't see, I think we can. Oh yeah, we can close the webinar. I would like, of course, to thank a lot all the participants and all the panelists for being here, for being patient and presenting a great talk. I'm sorry for the time, but the time was really short. And feel free, of course, to contact all of us if you want more information. Thanks a lot again, and see you in the near future.
Thanks.
Thanks.
Bye bye.
Just last word. I would like to ask to thank you, Fabrizio, for organizing this seminar, because it's been very interesting. And on the table we had a lot of different views, and so thanks again, Fabrizio, for organizing.
Yeah, this was the idea. Having from regulator, academia, industry, really having a wide view.
Thank you very much. I don't know, I lost a complete vision of everyone, and so I don't know if you see me, but we have problem with the network.
Yeah.
So, but thank you so much. Thank you very much. Thanks to all the speakers. It was
we see you, and we like the work that you are doing. And thanks to you, and wish to collaborate also.
Yeah.
Certainly, it was a very good occasion to meet each other.
Okay. Thanks a lot. And
Thank you.
Bye.
Bye.